so in love with you.
Welcome back to Real Estate Mindset. Today's video is gonna be absolutely bonkers. Now, the data is in, and it's really important to understand that the Federal Reserve and Jerome Powell are specifically telling us that they are taking a sledgehammer to the housing market in the form of bringing more inventory back, the rental market, but also the labor market. Now, here's the thing, you guys. I believe that home prices are gonna go down even without skyrocketing unemployment. But I do believe that there will be unemployment. I think that what is going to correspond closely with unemployment is foreclosures, not necessarily price decline, but foreclosures. So we're going to want to keep our eyes on that. Now, today's video, guys, is we're going to dig into why exactly the Federal Reserve is destroying us and crippling us and what they could have done to prevent this, because the cat's out of the bag. We all now know that the Federal Reserve acted too late. If they would have started quantitative tightening and stopped quantitative easing the beginning of 2021, I believe a lot of this could have been avoided, because obviously I get it. We went through, COVID, right? Everything was shut down. They needed to print money to keep us alive. The problem is they did too much, and now they're rug pulling us and taking it all away. Now, the victim of that, American families, American workers, okay? Here's the thing. The sad part about all this, guys, we need it to happen. We need the market to be reset because there's no fundamentals, okay? Not only is there no fundamentals, recently with these prices up the way they are, with the recent interest rate increase, that has priced out 15 million households. So again, you guys, 15 million households. And again, Fed's late to the party. What happened was essentially, just for the sake of argument, hyper demand. The Federal Reserve lifted the floodgates of demand. Everyone came in the market. Doesn't matter how much supply you have when there's hyper demand. And that's what happened. Shocking that so many people got it wrong. I hear a lot of these investors, YouTubers that, basically are playing Russian roulette with their viewers. They're spinning a cylinder saying, hopefully you don't shoot yourself. More than likely, there's 5 cylinders that are empty. So go buy a house. As long as you keep it for 6 years, you're going to be fine. Don't worry. Anytime someone says don't worry, usually red flag, right? Emergency, you need to start worrying. So regardless, guys, we're going to dig into a really, really good article that I found from NBC News that really breaks down what the Federal Reserve is doing and why they're taking an absolute sledgehammer to the housing market. Now, before I begin, guys, do me a favor and please like this video, subscribe if you haven't already, shoot me a comment below, and hit notifications, share the message if you can. Now, real quick, guys, my bio is as someone right now that is renting. I am a well-positioned buyer. I can go purchase property right now, but I have made a decision to hold back, to rent, and to find a deal of my dreams. Now, also remember, I'm a victim of my bad mistakes. In 2008, I had a foreclosure, repo, and a bankruptcy. Fast forward to today, I am a well-positioned buyer who's also a realtor, loan officer, and CE certified instructor in real estate. So, here's the thing, you guys. I know exactly what not to do, and that's what I'm sharing with you, okay? Now, the name of the article is Why the Fed is Taking a Sledgehammer to the Housing Market. As the central bank continues to aggressively raise interest rates in its battle to get inflation under control, the housing market is collateral damage. All right, so let's dig in here right away, you guys. Federal Reserve Chair Jerome Powell and members of his Federal Reserve Board might not be cruel and heartless people, but they are in the process of killing the American dream of home ownership for millions of families. As the central bank continues to aggressively raise interest rates in its battle to get inflation under control, the housing market is collateral damage. Sadly, it didn't have to be this way. After the Fed raised its benchmark rate on Wednesday for the 7th time this year, it's likely the dynamic will only get worse. For every percentage point increase in mortgage rates, now here's what's really interesting. For every percentage point increase in mortgage rates, the number of households who can afford a $400,000 mortgage declines by 3 to 4 million. So they're rug pulling tens of millions of people right now. According to Freddie Mac, the federally sponsored enterprise that promotes home lending, Freddie Mac estimates that 15 million potential home buyers have been priced out of the housing market this year because for the first time in U.S. history, the average 30-year fixed rate mortgage has more than doubled in a year's time from about 3 to 6%. So again, you guys remember that the prices went up because we're at 2 and 3% interest rates. So I want to, essentially let you guys know that even if we don't have rates in the 7 and 8%, in my opinion, prices are still going to go down. Fast forward to today, people have less money and are in more debt with no stimulus and no 2 and 3% interest rates. So I believe, I don't think we should go to 5% right now. I'm not saying that if we have 5% right now that we're going to be okay. I'm not saying that. What I'm saying is the more inventory we have, the more okay it is that we go down more on interest rates. That's what I'm saying. So, what I believe though, as long as interest rates are in the sixes, mid to high sixes, I think we're going to be perfectly fine as far as a house price crash. Now, a lot of people were worried that the Federal Reserve only lifted the federal funds rate 50 basis points. But here's the thing, you guys, that just means they're slowing down from the historical increase. It's still a massive increase. Remember, in 2008, 2009, 2010, they only lifted rates 10 to 20 basis points. All right, so 50 basis points is still more than double, right? Y'all see my point here? You guys, it's important to understand that the Federal Reserve is crippling the housing market on purpose. Now, if you want to buy right now, that's fine, but you're going to be going against the Federal Reserve and government. Not something that I would bet against. Just my opinion. Let's jump back in. As mortgage rates are rising faster, much faster than home prices will drop, Americans who do still buy new homes will be digging deeper into their wallets, adding to the financial stress of high inflation, and more financial pressure may be in the pipeline for the growing number of buyers who are now opting for adjustable rate mortgages. You guys, if you can't get a home with the fixed rate and you're not comfortable with the payment, then don't buy a house, right? This is the United States. We're not in Europe, okay? We can get fixed rates. Anyways, such mortgages make their payments lower in the short term, but they can easily adjust upward, often by 2% or more, several years down the road, making monthly installments intolerably expensive. So you guys don't want to have your payment double, right? I mean, that doesn't make sense. These financial pressures are coming after the COVID-19 relief program's federal moratorium on foreclosures ending in July 2021. Since then, foreclosure filings have been ballooning, up 57% in November compared to the same month last year. Though for now, there are nowhere near levels hit during the housing crash of 2008. Now, let me talk about the current foreclosure situation. There is no question in my mind that there are so many people in trouble and so many people that are going to be in default. But here's why we don't see massive foreclosures right now. Few reasons. Number one, way better financing. Okay. We have way better financing restrictions still to this day. Even with ARMs, we have way stricter financing. So that's one. Number two, okay, there's three things. Number two, the moratorium. They reset the whole foreclosure market, so it has to build back up, right? Foreclosure is a long process. Now, number three, the reason is loan modification. Loan modification from the data is proving very successful. And here's the thing, you guys, in my opinion, we should try to keep families in their homes. Okay, that's my opinion. And I get if they can't afford, they should never, blah, 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 blah. But you know what? I lost my house, guys, and crap happens that people just don't see coming: medical, divorce, family stuff. So you know what I say? Help these people out. Try to keep them in their house. But here's the other thing that I'm saying. We don't need a foreclosure crisis for housing prices to continue to go down at the level they are, okay? Now, I believe the foreclosures is going to depend on unemployment. I believe the higher unemployment, the more foreclosures. I don't think that the prices are going to have as much to do with that versus the unemployment, but only time will tell. But again, you guys, the Federal Reserve is hammering us. The job market, the housing market, rental market. I mean, we're getting absolutely hammered right now. And, as an American citizen, we're probably not going to feel the relief until, 2020, the end of 2023, maybe even 2024, if at all, right? Kind of scary times. Let's get back into the article. Already the housing market, which accounts for nearly 18%, you guys. So 18% of the US economy, so huge, right, is in serious recession, with home sales sinking and prices beginning to fall. With inflation now running at an annual rate of 7.1% as measured by November's Consumer Price Index, the Fed is trying to slow it through a process that economists call demand destruction. By rising interest rates, the central bank makes it more expensive to borrow and spend. As the most interest sensitive sector of the economy, housing gets slammed. So this is essentially saying, you guys, that that the Federal Reserve has no choice but to cripple the housing market. It accounts for 18% of our economy, and shelter accounts for 32% of CPI. So in other words, they have no choice. We're going to get crushed. So warning, warning, right? I don't understand why everyone can't see this. It is what it is. Let's jump back in. It's not just prospective home buyers who are suffering the consequences of sharply higher mortgage rates. Homeowners are finding they can't sell their homes for what they were worth just a few months ago. This is particularly troublesome for couples approaching retirement, such as neighbors of mine who are looking to downsize. 3 months ago, a home very comparable to theirs sold in our neighborhood for an impressive price of more than 1.3 million. But the couple recognized they are now selling in a declining market, so they listed their home for just under $1 million. So $300,000 less. Okay, so this is going into the retirement, to people a little bit older, and how the housing market crash is messing up, retired people. And that's not good because they're on a fixed income usually. It's as if a chunk of their nest egg has suddenly been snatched from underneath them or rug pulled. Sadly, had the Federal Reserve been more vigilant on its inflation watch, much of this pain could have been avoided. The Fed's mandate to maintain price stability while attempting to maximize employment, and among its primary tools is the Fed funds rate. It's the cost of borrowing for the banks. They, of course, pass the cost on to the customers while also trying their mortgage rates to Treasury bond yields, which have shot up this year, reflecting rising inflation expectations. So as more and more Americans go into retirement age, you guys, they're going to downsize. I mean, they have to pay property taxes, they have to pay insurance, HOAs, anyone that has a second home or investment property. So, and here's the thing, especially in Florida, a lot of people have second homes. So if we go into this crash and it gets really, really out of control, like I think it will, I'm telling you guys right now, a lot of people are going to liquidate their second homes because they want to retire and they're sick of this crap. They just want to liquidate, right? There's going to be a certain percentage of people that do that, and then there's going to be a certain percentage of people that don't. But it's really going to be interesting to see how this current market crash affects the rich and affects investors, right? Unlike 2008, where it really affected a lot of people, but predominantly primary residences for people that were poorly financed, right? So it's going to be interesting as we continue. Let's finish out the article right now, and then I'll do my conclusion. As it turned out, the central bank was helping to fuel the inflation it was supposed to be preventing. The Fed's footprint was pressing on the economic accelerator far too long as it persisted in extraordinary efforts to prevent the country from falling into a pandemic-induced recession. And it failed to hit the brakes in the summer of 2021 when inflation began to accelerate. A humbled Powell would later concede it was time to retire his description of inflation as transitory and admitted, I think we understand better how little we understand about inflation. That's kind of scary. That means they kind of flying blind to me. Now the Fed is trying to compensate for its mistakes by rising interest rates at the fastest pace in 40 years. As the housing market slumps, the Federal Reserve is fighting a battle not only to curb inflation, but to restore its reputation as an inflation fighter. Sadly, this is a necessary evil because of our country's economic stability requires that we keep inflation under control, and that's the Fed's job. But if the nation's central bank had more foresight, it would not be so hard today for millions of people to achieve home ownership and a secure retirement. Okay, guys, so in conclusion, I have one question that I want you to answer below, okay? So my question is, do you guys think that the Federal Reserve, based on their history, based on the past, based on what's happening, do you guys think the Federal Reserve is going to overcorrect, leading us to a worse housing market crash than we would have had to been in? So again, do you guys think the Federal Reserve is going to overcorrect during their quantitative tightening? Let me know below, you guys. No, other than that, I really appreciate you guys watching me. I appreciate you guys following my journey. You guys know I want to become a homeowner, and I'm going to take you through that process. Now, obviously, I have started the process, and the first step for me purchasing a home is getting qualified. And again, not right before I want to buy, okay? So I possibly want to buy in February, so 2 to 3 months from now. So 2 to 3 months from when you want to purchase, that's when you start at least needing to get prepared. So that's what I have done, you guys. And I'm going to continue to share that journey with you. But other than that, guys, I hope you guys got some value, insights, and perspective from today's video. And if you're out there investing in real estate, you know I wish you luck, and I hope you win.